With the Reserve Bank rate rise today, it's inevitable. The banks and lenders will raise their interest rates as soon as they possibly can. And that means the days of mortgages with a 1 in front of them are pretty much all gone and done. It also means, as the Treasurer told us, higher costs are coming for business and for homeowners. So let's bring in here Sally Tindall, Research Director at interest rate monitoring business RateCity. Always good to have you on the program, Sally. So, banks inevitably pass this on, but we've had 0.25%, then we've had 0.5%.
Yep.
This is only the start of it, isn't it?
Oh, it sure is. The RBA is going to take a rapid-fire approach to hiking the cash rate from here on in. We expect a wild ride over the next 6 to 12, possibly 18 months. Forecasts are for the cash rate to get to 1.75 by Christmas and potentially 2.5 by Christmas next year. In fact, it could be even higher if the markets are right.
So the markets are saying 3%, even though they're coming off a little bit. So let's have a little look at the impact of a 0.5% rate rise today. So you're saying on $500,000, it's an extra $133 after tax that comes out of somebody's pocket.
Absolutely.
$1 million loan these days is pretty common, so that's $265. So if I do the maths pretty quickly, that's already $200 for every $500,000 that you've borrowed. Per month that's coming out of you already. And as we're saying, we're only at the start.
We're only at the start. It's going to be a big shock for some families. So if we're looking at, someone with a $500,000 loan, Christmas next year, they're looking at $652 extra in total in their monthly repayments.
So $652, I can do quick maths, that's about $32,000 a year after tax extra they're paying.
What a huge increase. And then if you look even further on $1 million loan, you're looking at $1,303 in total every single month.
I'm pretty smart. I can work out that's about $60,000. On $1 million loan, you need to come up with another $60,000 after tax. So here we go. There's the expectations at the end of 2022, but that's only 1.75%, as we're saying.
Right. We're saying at 2023, you're going to get even higher to 2.5% cash rate.
Here it is.
There it is, $652 extra a month for that $500K loan. For $1 million loan.
So then the question is, if somebody has to buy your house off you, have they actually got the financial capacity to pay that interest rate to buy your house off you? That's where housing prices come into question.
It's going to be really interesting over the next 6 to 12 months to see how the property market responds, because we're already seeing significant drops in Sydney and Melbourne. They are set to continue on. Why? Because when interest rates were on the way down, people went to their bank, they found out how much they could borrow, they worked out they could borrow more, started bidding more at auctions. Now, the reverse is going to happen. Interest rates start going up, people will find their maximum borrowing capacity shrinks and they won't be able to bid as much.
OK, so one thing about it is that lenders' margins improve as rates rise. They make more profit. But then also some might just try to pinch a bit of market share off others. ANZ is one that's lost a whole lot of market share. It's been out of the mortgage market for a long time. So what happens now? Do they try and play a few games?
I think there'll be some games that are played, I'm sure. The good thing about all of this is that the competition in the home loan market is still incredibly strong. And so you will see some banks hiking by the full 50 basis points, but then cutting for new customers. That's what ANZ did last month. Now, who is this good for? Anyone willing to refinance or renegotiate their home loan. One little catch, though, they will need to meet the bank's serviceability tests on those higher rates. And if if budgets are tight, they might not be able to meet those tests.
And just very quickly, we know that also fixed rate mortgages, that almost as much as 45% of people over the past 12 months have taken out a fixed rate mortgage. Now, generally they've taken them out for 2 years.
Yep.
So in many cases, those people are going to come out as these interest rates are hitting their peak. So they're going to come out of very low interest rate loans, 2%, 2.2%, and they're going to go smash, potentially straight into a 4.5% mortgage.
OK, so these people are on easy street right now. They're probably paying under 2% if they were lucky and they pounced when rates were that low. Yes. In July, this is when the Big Four banks say that the peak of people coming off a fixed rate will hit. July to December of next year, their rates could double. In fact, more than double, if the current forecast is to believe. And so that's going to spell trouble. But it will act as another natural tightening. It may mean that the RBA might not go just as high eventually.
And that's the argument, is maybe the RBA doesn't go quite as high. I tell you what, Sally, always good to have you in the program. We'll do it again very shortly. Sally Tindall there from RateCity.